want to record this today, so we'll put a copy of this on our YouTube site if anybody wants a follow-up or anything. But I'm David Fear, the President and CEO of Shepler Fear General Agency up here in the Sacramento area. I appreciate all of you taking time out of your busy days to join us, and hope this will be a good 30-35 minute adventure for you. One of the things that I would make a suggestion on, just as a little bit of a housekeeping, is that there is a tendency sometimes, if you don't mute your phone, tendency sometimes it will pull in some background noise, and I'm not sure how to really control that well. So what I would say is keep your phone on mute, and what we'll do is, as we go, if you have questions, you take your phone off of mute and feel free to ask. We will have allocated some time at the end of the presentation to kind of address any questions you have. So that would be fine at that time as well. At any rate, let's go ahead and get started. Welcome to all of you who are on the call, and this is our I think our third presentation of this particular topic, which is level funded health benefits, a win-win proposition. We started doing these webinars about 3 months ago, and so we're trying to kind of each month maybe recycle each one of the presentations. We last week my son David Jr. did the presentation on a legislative update with all of the stuff going on in Sacramento and in Washington D.C. He gave a legislative update, and we did record that, and that's on our YouTube website as well. And then we've had a couple of other prior ones, one on reference-based pricing, which we're going to repeat that one in 2 weeks, and I think that'll be of great interest to many of you, because reference-based pricing is making a huge dent in the healthcare cost market. And then we have another one on HRAs and what that's about, especially with this new employer excess loss product that we've come out with. So anyway, we've got about 4 different topics, and we'll be adding a couple of new topics this summer. So stay tuned for more stuff. At any rate, moving ahead here. I don't think it takes a rocket scientist to know that anybody in this business knows that health insurance premium costs continue to rise dramatically in spite of what's being done at the federal level to try and supposedly contain costs. We're continuing to see double-digit rate increases on health insurance, and for that reason, most large employers have now dropped their traditional fully insured coverage and have opted for self-funded programs. And in fact, some of the statistics that I'm aware of is that it's something like 75 to 80% of large employers with 1,000 or more employees now offer at least one self-funded plan option to their employees now. And that number has dramatically increased since 2014, when the ACA went into law. But self-funding isn't new. It's been pretty popular with large employers for over 50 years. Most of the employers will tell you that it's popular because A, it's better cash flow. They only have to pay for costs as they're incurred. They have the ability to retain year-end surplus, thus by eliminating carrier profits that they perceive are in their rates. It allows them to hold their own claim reserve costs, which in many cases will amount to 20% of your premium dollars are held in reserve by a carrier, and self-funded employers get to hold their own reserves. It avoids state benefit mandates and premium taxes because of ERISA. Self-funded plans are governed under federal ERISA law. And then the biggest thing they tell us is the fact that they've got the ability to custom design their benefits so that they're subject only to federal but not state rules, and at the same time they put a lot of innovative plan designs in on their self-funded plans. So we've seen over the last 30 years that I've been doing this, I've seen a lot of really interesting plan designs. So again, as I said before, many reports are that almost 80% of large employers are now self-funding their group medical, dental, vision, and RX plans. In general, and I'm not going to get into a lot of depth on self-funding itself, but there are some basic things that we need to make sure we understand. And self-funding typically consists of three general cost components: the cost of stop-loss insurance to protect the plan from large catastrophic claims on any one person, and we refer to that as specific stop-loss, and then protect their plan from overall high claims for the group as a whole, and we refer to that as an aggregate stop-loss. Those are two very important forms of insurance that most self-funded plans will contract with. Additionally, they'll pay a cost for administrative services, which are typically either provided by an insurance company through what's called an ASO, or administrative services only arrangement, or by a licensed bonded third-party administrator, or TPA. Many insurance companies now offer ASO programs, but also they now endorse or work with a number of third-party administrators as well. So you see a lot of mixing between ASO and TPA programs. The third cost of self-funding involves the actual claims, what I call incurred and paid healthcare claims, and those will vary by the benefit design and the use of managed care networks. But as you can see in the typical stop-loss self-funded plan dollar, the bulk of costs are allocated for the payment of claims, and that, again, that varies by employer and by plan design. Self-funded plans are typically what we call a pay-as-you-go arrangement, whereby the employer pays the fixed costs each month, stop-loss premium and administrative cost each month based on the number of enrolled people, and then they pay the claims as the claims are incurred and presented for payment. So in other words, they pay the minimum needed to maintain the plan, and they don't build up necessarily a surplus of plan dollars. Now that, again, that depends on the employer and what their financial issues are. They also show on their books the liability for what we call IBNR, or incurred but not reported claims, which may be paid after the end of each plan year or after the plan is terminated. So, if we're saying that 20 cents out of every dollar in a self-funded plan should be allocated for reserves, those reserves are to pay for these incurred but unreported claims that get presented later on down the road. And so these are all, what self-funding looks and works like has really not changed a lot in the last 30 some odd years. The issue that we deal with here is, whether or not self-funding is really applicable or available for small employers. And as you know, the definition of small employer has changed somewhat. In the old days, a small employer was considered anybody less than 1,000. Now, by law, small employer is defined in many states as employers with 50 or fewer employees. In California, the definition is now 100 or fewer. So small employers in the past were saying, hey, we don't think that self-funding is a good idea. And traditional thinking is that only the large employers who were paying about $1 million a year in fully insured premium were good candidates for self-funding. Self-funding can be tricky. It can present some cash flow challenges. Self-funding, contracts typically require the employer to pay a claim and then get reimbursed by their stop-loss insurer. And so in the past, only the largest employers were doing self-funding because they had the cash flow to be able to, wait to have a claim reimbursed. And give you a simple example, and 20 some odd years ago, I had an employer in Fresno. They had an employee whose spouse had a set of premature twins. The cost on that was about $2.5 million to keep those twins alive for their first 6 months of life. That employer happened to have a $100,000 specific stop loss, and the carrier at that time wanted to have the employer pay the full $2.5 million of claims and then get reimbursed the $2.4 million of stop loss coverage. That's not what happened, but that's what many employers expected to have happened years ago. Today, what you have are new types of contracts that don't require employers to fund all that claims cost and then wait to get reimbursed. And as a result of that, you know, in the past, small employers weren't considered to be good candidates for self-funding, but now you've got these new contracts that say to a small employer, you just pay your specific deductible and we'll pay the balance. So, you know, the last 20 years, when you think about it, small employers now are paying, you know, in excess of $1 million. I'll show you in a minute an example of an employer with about 130 people down in San Diego, and quite frankly, their annual bill for their fully insured premium from a certain carrier whose name I will not say was almost $1.3 million, and that's a lot of money. So it's not uncommon to see an employer with 75 people pay close to $1 million in annual premium. Stop loss insurers, as I mentioned, have developed new products to attract small employers in the market. They provide what's called a monthly aggregate accommodation, which means that aggregate stop loss of say $500,000 a year would be have a $40-some-odd thousand a month attachment point. So you don't have a serious cash flow issue. I mentioned already what's called advanced specific funding, where the employer does not have to pay the full cost of the claim, just whatever their specific deductible is. They also have contracts that have what's called a paid claims runoff coverage feature, so that if they terminate their plan, or their plan has claims that are incurred but not reported for payment until 3 or 4 months after the end of the plan year, the coverage will cover those claims even though they've been presented after the fact. And then there are other plans that have what's called guaranteed terminal liability options. So these are a lot of different features that you'll see in the self-funded, the stop loss market that are very important to know and understand. Level funding, which is what today's presentation is about, is really the rebirth of an old idea. You know, years ago, insurers offered what was called a minimum premium program that looked like a traditional fully insured plan, but it refunded dollars in the event that their incurred and paid claims fell below an annual claims threshold. Today, that product is referred to as level funding, and today's version is also referred to as monthly aggregate stop loss, which prevents adverse cash flow. Today's version of minimum premium or level funding includes the specific stop loss coverage that has these advanced funding features. And today's version of level funding includes these provisions for runoff claims at the end of the plan year. So the good news is this: level funding is now available for groups with as few as 10 employees, depending on the state that you're in. And we write at Shepler Fear, we write a fair amount of level funded business. We do this with groups that have as few as 10 participating employees, and it does work. So let's talk a little bit more about what level funding looks like. It looks like fully insured coverage, but it's actually a self-funded program that features these stop loss coverages built in, and it guarantees that the employer has a maximum cost of coverage. In other words, if at the beginning of the year, that employer is expected to fund and budget for this maximum amount of exposure. And as a result of that, that means that at the end of the year, if they have a surplus, they get money back. As a self-funded product, level funding is not regulated by state insurance law, and it's not subject to state benefit mandates or state premium taxes, and that can be attractive. And their premium taxes in some states are as much as 5-6%. California, I think it's about 3%. Level funding, like self-funding, is again only subject to federal laws such as ERISA, COBRA, TEFRA, and of course the ACA. And so the question is always, well, why is it attractive? Because it does two things. It guarantees the employer a maximum annual cost of coverage. They can take that to the bank and know that their cost will not be any higher than X. And at the same time, it agrees to return any surplus to the employer if the claims are below that projected maximum claims level. And I would say right now about 90% of our clients who are in a level funded program are getting refunds, premium refunds after the end of their plan year. I think I've got somebody who needs to mute their phone there, okay? So those are the two main reasons why employers are looking at level funding, and they're looking at it favorably, is because of this maximum annual cost and the ability to retain year-end surplus. So the other part of level funding that needs to be explained very carefully is that most level funded programs do what's called a health risk assessment, and let me explain what that means. In a self-funded program, the employer buys an aggregate stop loss, which provides what's called an aggregate attachment point. In other words, it's the maximum amount of claims that the employer has to budget to pay during the year. Well, in traditional self-funded plans, that carrier sells you an aggregate stop loss based on prior year's claims experience. So, you know, if last year the employer had $100,000 of claims, then they believe that those claims are going to increase this year by trend, and let's just say trend is 13%. So that $100,000 of claims last year will grow to $113,000 this year because of healthcare trend, and I think everybody knows what that's about. And then they typically set the aggregate attachment point at 125% of what projected paid claims are going to be. There are options to have it higher or lower than that, but for the most part, these aggregate attachment points are set at about 125% of what projected claims are going to be. Well, here's the problem. If you don't know what the projected claims are because you don't have past claims history, and most small employers don't have any of that, or large employers, for example, who are enrolled in an HMO plan that doesn't provide claims experience. You know, Kaiser, Blue Cross, Blue Shield, their HMO plans, they don't provide any claims experience. So you have really no idea of where the claims are going to be at. So what happens is because of the limitations, and under a level funded program, the annual aggregate attachment point can be determined through the use of a health risk assessment process. And the processes can be done a number of different ways, but basically what it means is this. Each individual who's going to enroll in the plan answers some basic health questions. You know, do you use prescription drugs? If so, what drugs are you using? What's your dosage, etc.? Do you have any ongoing conditions that you're receiving treated for? This is confidential information. The employer doesn't see any of this, but the health risk assessment organization gets this information, compiles it together, puts it into what I call a loss profile, and comes back to the employer and says, okay, based on this loss profile, we believe that your paid claims are going to be X. And as a result of that, your annual aggregate attachment point will be X plus, you know, 20% or 25% or whatever it's going to be. What I have found is that while that may sound kind of negative to some brokers and employers, it's actually a great tool, because if I've got an employer sitting down and they're thinking about self-funding for the first time and they really don't know what their claims are like or anything, doing this health risk assessment is a great tool to really determine up front whether or not they should be doing this. I mean, if they've got a group that's very sick and has a lot of ongoing things, maybe the best thing for them to do is to stay in a fully insured, you know, a program where the carrier has all the risk. But if they've got, you know, if they've got a normal group, you know, you're going to have a few people that are going to have conditions here and there. You're going to have a number of people that use prescription drugs, et cetera, et cetera. And those characteristics, mean that the average group we can look at and say they're predictable in terms of what their healthcare claims are going to look like. So these health risk assessments are done free of charge by the carrier or stop loss insurer, and that process is generally done either like paper or a fax or an online or even a telephonic system. Typically, a group of 100 they might be given, say, a 2-week period to complete their health risk assessment and send that into the a toll-free number, or to call into a toll-free number and have that done. And generally, within 24 to 48 hours after the assessments are all reviewed, we get a final pronouncement back from the carrier about here's where the final numbers will be for this employer. But I want to stress the fact that these assessments are a great way for the employer to determine, before a commitment is made, before money is exchanged, whether or not they're a good candidate for self-funding. And as I said, it doesn't cost them anything to do this. We think this health risk assessment process is really a great risk management tool for self-funded employers. Let me talk for a minute then about plan designs under self-funding. As I mentioned before, one of the popular reasons for self-funding by employers is the ability to custom design your plan of benefits. You got deductibles, co-insurance, co-payments, and maximum out-of-pocket, RX, all that stuff. And these things can generally be customized for what the employer wants. Many employers will say, look, I want a plan that really is close to what I have now with the XYZ insurance plan. And so many times we'll design that plan to duplicate those benefits. What we're finding is that nearly 100% of plans today are using some sort of managed care network or use the new reference-based pricing strategy, which uses a percentage of Medicare for payment to providers. And as I mentioned earlier, we have a separate presentation on reference-based pricing, and if you have a chance in 2 weeks to join us to talk about that, I think you'll really be impressed with the information, because reference-based pricing is really showing some great dividends, and it's being accepted more and more throughout the country. Typically, a self-funded employer will rent a PPO network. In many cases, many of our clients are using, say, the Aetna or the Cigna PPO networks, First Health, others. Some of our clients are actually using a Blues network as well. In many cases, both Anthem Blue Cross or Blue Shield of California will rent their provider networks through TPAs on these level-funded programs. And most of the plans that we see today are using consumer-directed plan features. They're either putting in health reimbursement arrangements or health savings account plans that really get the individual employee more involved in the selection of their health care. And not all, but many plan designs now incorporate wellness and safety features, rewarding employees for healthy lifestyles and actions, both at home and at work. So these are the kinds of things that you can do in plan design features with a self-funded or level-funded plan. Now I want to show you some numerical examples. And this is an employer that had 130 employees in San Diego. And the numbers that I'm going to show you, quite frankly, are fairly indicative of what a typical employer will be finding. This particular employer was offering a choice of 2 HMO plans with a major carrier whose name we all know. One had a full network and the other had a narrow provider network. $1,500 deductible, 75% coinsurance, $2,500 maximum out of pocket. I would call that a fairly rich benefit, because in most cases they're waiving this deductible. This $1,500 deductible was waived for non-facility things. It didn't apply to office visits and prescription drugs and things like that. So it was a fairly rich plan. Their fully insured rates were $464.71 a month times 69 single employees, $1,057 for those with spouses, 1,103 for those with children, and full family rate was 1,371. So before their renewal, they were paying annually $1.2 million in annual premium. Their renewal went up by about 12% to about just under $1.3 million of annual premium cost, and that was a traditional HMO plan, no refunds, no anything. That they paid that money and didn't worry about a thing. So then we looked at that employer and we showed them what level funding would look like. Again, we kept the same benefit design that they had before. We made a couple of minor modifications, but for the most part it was the same plan design. We put in a PPO network using an EPO plan design, meaning that if they used the PPO providers, they got network benefits. If they went outside of the network, they had a very, very high deductible. So there were non-network benefits available, but they were, subject to a $5,000 deductible, which means we expect you to stay in the network as much as possible. The maximum cost under this program was about $1.2 million a year, and if you broke out those costs, about $558,000 a year was paying for specific and aggregate stop-loss premium. About $62,000 a year, about 5% of the total cost, was for administrative services and PPO network fees. And then their maximum claims, their estimated maximum claims, were going to be limited at $574,250. Now that was verified through the use of a health risk questionnaire. So at the end of the day, when they came back, it was shown that their risk categoristics were right in line with what we thought they'd be. So their overall costs basically saw about 50 cents on the dollar going into their claims fund, and that means that if their claims fund is actually has a surplus at the end of the year, they're getting that money back. So for them, it's I want to be clear about this. We didn't go in there with some fictitiously low first-year rate to try and get their business. In fact, the rate, as you can see here, was just about close to what their renewal was going to be, just a little bit under it. And at the end of the day, their feeling was, look, if we're going to pay the same amount of money in self-funding that we're going to pay in a fully insured plan, but we have the ability to get money back because we have a good year, then why wouldn't we do it? And that's the big reason why most of these employers are looking at level funding, is they've got nothing to lose and something to gain. And what we tell them is that typically 4 out of 5 years, they will get some sort of a refund. There might be 1 year out of 5 that things go bad and they have their maximum claims, and of course they're protected under their stop-loss policy, but that they may not get a refund in 1 out of 5 years. But employers are saying, well, you know what, I wasn't getting any refund before, so getting something 4 out of 5 years is a pretty positive thing for me. So here are the key points about level funding that we need to remember. Typically a level funded plan, if it's done right, is going to cost about the same as a traditional fully insured plan. Rarely will a level funded plan come in with a dramatically lower first year rate, okay? And if it did, I think something's wrong, okay? Because I don't think that's the way these things are being underwritten. And why do it? Because the ability to retain their year-end claim surplus, the options they have to have guaranteed runoff limits so that they know that if they terminate their plan, they have a guaranteed amount of what their liability will be for incurred but unreported claims, and that's funded in their plan each year. They have aggregate and specific stop-loss contracts that allow for 6, 9, 12-month incurred and paid coverage so that they've got the claims lag insured under their program. And then they have various surplus alternatives. Typically the most popular one is that whatever surplus they have, they get 100% of that back. But there are some carriers that says, look, how about we do this? We'll charge you a lower administrative fee up front if you agree to give us, say, 1/2 or 1/3 of the surplus. So the carrier is kind of saying, we'll lower our administrative rate to you if you'll give us a piece of the profit. And some employers will do that. And then, as I said before, nearly being able to customize their benefit plan with multiple features and use of different provider networks. So to us, it's a win-win solution. They're guaranteed a maximum cost through this use of a health risk assessment process. The worst case scenario is they're not going to pay more than they would have with a fully insured plan. Best case scenario is they get a refund of claims dollars. They could duplicate, for the most part, their in-force benefits, or they can incorporate a totally customized plan that meets their needs. It avoids state benefit taxes and mandates, and again, those can really add up. They have used a wide variety of provider networks and administrators, and we work with several different third-party administrators and carriers and provider networks. And here's the other part of it from a broker perspective, is that broker compensation can be just as good as a traditional fully insured plan. You have the ability to load a broker commission in here. Of course, just like any other plan, that has to be disclosed to the client. But you know, if you're making about a 4 or 5% broker commission on a large group fully insured plan, you can expect to get that same type of compensation under a level funded plan. So you're not having to give up a lot, if any, of your compensation. So, you know, I think we know what we're doing at Shepler Fear. I've been doing self-funded for almost 30 years. As an organization, we started doing level funding about 6 years ago, and frankly, it's been great for us. We represent a number of different carriers. We're adding some all the time, as you can see. Starmark, Allied, the Protect Plan by Meritain, which is an Aetna product, Healthy Choices Level Funding, which is a product with Cigna. So we have good markets there, and frankly, it typically takes about maybe a week to 10 days to get a level funded quote through to you, because it is large group. We do have the ability in some cases for groups of under 100 to do the quotes right here in-house and turn those around within 48 hours to you. So I'm going to encourage you now to take your phones off of mute, and if you have questions, feel free to throw them my way.
Dave, Rob here. I've got a couple of questions.
Okay.
Number one, when we talk about the type of plan, how much flexibility in the actual benefits do we have on this level plan? Can we offer them better benefits than what they've had before, or does that ruin the whole financial numbers?
You can offer them a better benefit design than what they had before. Again, many employers try to duplicate the benefits they had before. Some employers do try to downgrade it and then maybe put back in an HRA or something. So it's very flexible, and depending on the carrier and the template plan document that they use, you can do quite a bit of customization of benefits.
I see. And how do you, is there a way when you're prospecting, would we be prospecting for level funding or just prospecting for flexible funding? How do you present something like this to a prospect that you're speaking with for the first time?
You know, Rob, that is a really good question, and I'll tell you the answer is going to maybe sound cheesy, but I'll tell you what success we've had. You know, you walk into an employer's office and you say, you know, you're offering group health right now. Yeah, I am. And I said, you know, how much money are you spending? Well, I'm spending, you know, $500,000 a year. And I said, have you ever gotten a refund back from your carrier? And they look at you and they laugh. They go, no, why would I get a refund? Well, I mean, if your carrier is making money, if your carrier is paying out fewer claims, do they give you any of that surplus back? Well, no. And I said, would you like to see a plan that gives you money back if you have a good year? And they always say yes. Why? Because, well, it's just normal. You know, why wouldn't I get a refund? Why wouldn't I get a rebate for overpayment? And you know, I don't really go into, you know, let's talk about self-funding or level funding. I just simply say there is a way to set up your plan now under, you know, under the law, and it's legal and it's regulated by federal law to do this, where you can set up your plan and arrange to get a refund back of surplus when you have a good year, and yet you don't pay any more out than you would have paid had you remained fully insured. And at that point they said, I'd like to see what that looks like. So I don't mention self-funding. I don't mention level funding because most of the time they have no idea what that is anyway. I just ask the question, you know, would you like to look at a plan that gives you money back if you have a good year?
Doesn't sound cheesy to me. Sounds great.
Well, I tried it the other way before, and you know, they'd look at you and say, oh, I don't want to talk about self-funding. You know, I've heard bad stories and this and that. And you know, why go through that? Why not say, look, if you're going to spend $1 million, would you like a plan that gives you a refund when you have a low claims year? And nobody ever says no to that.
I'm wondering if it would be, if I'm approaching a business owner, if I say something to the effect of, and I know what you said, but if I say, I'm wondering if it would be accurate. If I said we specialize in helping firms upgrade their employee benefits plan and get a portion of their premium refunded at renewal instead of receiving a rate hike. Is that too?
Well, I think that's
too much there.
Well, I think you might be. I mean, I think you say, you know, we specialize in employee benefit programs that are both fully insured and self-insured, and there are various hybrid plans that allow you flexibility in your plan design. You could increase your benefits without increasing your cost. You could lower your cost without decreasing your benefits. You know, give them the option of increasing benefits without increasing costs, or decreasing costs without reducing benefits. And somewhere between those 2 points, they get interested.
Right. All right, that's great. Thank you.
You're welcome. You're welcome. Other questions? Well, I know it's a Friday, and it's a nice day outside. So I'll tell you what we'll do. We'll go ahead and conclude. And I appreciate your questions. If any of you want to get back to me individually, one-on-one, you can reach me at our toll-free number on the slide, 877-361-7342, and you can speak to either Jennifer Mason or myself. And we're happy to chat with you about prospects you have, or marketing ideas that you may want to look at. So with that in mind, thank you very much for attending today's webinar, and hope you have a great weekend. Take care. Bye-bye.